All right, let's settle one of the biggest financial debates out there: real estate or stocks? It's a question that can literally shape your entire financial life. And today, we're going to dig in and find the real answer.
I love this quote because it just gets right to the heart of the matter. When we talk about building wealth, the easy, obvious answer is almost never the whole story. Both sides of this debate tend to leave out some pretty crucial details. So, to really get to the bottom of this, we're going to follow the journey of two identical investors. They start in the exact same spot with the exact same amount of money, but over 2 decades, their choices send them down two completely different paths.
So let's meet our two investors, Jake and Marcus. Jake takes his 50 grand and puts it down on a rental property. He's got keys in his hand, a mortgage, a tenant. It feels big, it feels real. Then you've got Marcus. He puts his 50 grand into a simple stock market index fund, basically owning a tiny slice of the whole market, and he sets up an automatic $300 a month investment. His choice? It feels kind of boring, right? Abstract, slow, but let's see how this plays out.
So, right out of the gate, Jake feels like he made the right call. I mean, he's collecting rent checks, and his simple back-of-the-napkin math seems to prove he's an absolute genius. And here's that napkin math. 470 bucks. That's what he thinks he's profiting every single month after the mortgage is paid. Looks fantastic, doesn't it? Almost $500 a month for doing nothing. But here's the thing, that number, it's pretty much a mirage.
See, that rent check isn't pure profit. Oh no, it gets eaten alive by a whole list of hidden costs. You've got property taxes, insurance, the month or two the place sits empty, and then the big stuff. The new roof, the water heater that explodes at 3 a.m. These aren't maybes, they're guarantees.
So when you do the real math, after just a few of these actual real-world expenses over the first 3 years, Jake's amazing cash flow isn't the $16,000 he was expecting. It's closer to $3,000 total, and that doesn't even begin to account for a single hour of his own time and stress. Okay, so as the years start to tick by, two incredibly powerful but totally different financial engines start to really rev up and take over, driving the wealth for both Jake and Marcus. So let's check the scoreboard. Early on, you might be surprised to hear that Marcus and his boring little stock portfolio are actually ahead. But as Jake's house value starts to climb, he closes the gap. And by the 10-year mark, well, would you look at that? It's basically a photo finish. They are neck and neck, both sitting on about $170,000 in new wealth. So what's Jake's secret weapon? It's one word: leverage. Think about it. He used $50,000 of his own dollars to control a $250,000 asset. So when the whole asset goes up in value, his returns get amplified like crazy. It is the absolute superpower of real estate. And Marcus, his power is a little sneakier. It's called compounding. His money isn't just growing, it's having babies. And then those babies are having babies. It starts off so slow you barely even notice it, but then it hits a curve and becomes this unstoppable financial avalanche. It's quiet, but man, is it powerful. So we're tied at the 10-year mark. But the next 10 years, well, that's where the story gets really interesting. Let's fast forward to the finish line, the 20-year mark, and see who actually came out on top. And the final result is fascinating. After 20 years of work, repairs, tenants, and stress, Jake's net worth is somewhere between $400,000 and $500,000. Pretty good. But Marcus, who spent exactly 0 hours actively managing his investment, has a net worth in the exact same ballpark. Just think about that for a second. Jake worked for his money. Marcus's money worked for him. Okay, so if they basically ended up in the same place, what's the lesson here? It tells us the final number isn't the whole story. The journey is just as important. So let's break down the unique advantages each path really offers, because this is where you can start to figure out which team you're on. Look, real estate has some powers that stocks can only dream about. You get that insane leverage, you're the one in control, and the tax breaks are just incredible. You can literally deduct something called depreciation, which means the government lets you pretend the house is losing value for tax purposes, even while it's actually gaining value in the real world. It's wild. But then you look at stocks, and their superpower: total blissful simplicity. It is 100% hands-off. You need your money, you can have cash in a few days, you aren't all in on one house on one street, you own a tiny piece of thousands of companies. And of course, maybe the best part, no tenants, no toilets, and no 2 a.m. phone calls about a broken pipe. So after all this, it's pretty clear that the common arguments you hear are, well, incomplete.
The real estate people brag about the rent checks, but they forget to mention the new furnace. The stock market people celebrate the highs, but they don't talk about the gut-wrenching volatility, those 30% drops that cause people to panic and sell at the worst possible time.
And that really brings us to the most important takeaway. It's not that one is better than the other. The real question is which one is better for you. Are you an active operator or a passive owner? The trap isn't choosing the wrong asset. It's choosing one without understanding all the costs, not just in dollars, but in your time, your stress, and your sleep. The only right answer is the one that includes everything.